Hi, I'm Brett Cenkus, a business attorney focusing on mergers and acquisitions, or M&A, and an M&A broker. And today we're talking about two critical mistakes, things to avoid as a seller when structuring an earnout for the sale of your business. Before we get into it, if you have a general question, you can drop it below in the comments. If you have a specific question, want to start getting advice and thinking through your unique situation, you can book a paid call with me at clarity.fm/Brett Cenkus. The link to that is in the description to this video. So, two things to avoid. The first is fairly, you might not have thought about it, but it's fairly obvious when I explain it. The second, less so, and arguably even more important. But let's get right into it. So an earnout is contingent purchase price. It's additional money you may receive as a seller for the sale of your business, but it's not guaranteed. It's based on post-closing metrics or performance of the business. It can be tied to anything. It can be tied to a certain number of customers remaining, customer growth, employees staying, but often it's tied to revenue or earnings. First thing to avoid, but by the way, if you watch any of my other videos, you know I don't normally trade in absolutes. I talk about things being nuanced and everything is negotiable, and these items are too. However, they are things to avoid when structuring your earnout unless you absolutely, with full intention, accept the risks and consequences of structuring your earnout in, one of these or two ways or both of these ways. So in other words, you want to run from doing this. You do not want to do this unless it's the only way to get a deal done or again, be careful. Be careful. These are serious mistakes from a seller standpoint when structuring an earnout. The first, is don't base your metric, success, the threshold, whether or not you earn the earnout, on profit or earnings, any sort of net number. That is a huge mistake. Number one, you won't have visibility. You won't have great visibility. Even with a well-structured written audit right under a purchase agreement, you're going to lack information. There's an asymmetric information issue going on here between you and the buyer that's going to make it hard to understand exactly how the buyer got to that net number. Also, even the most ethical buyer is not going to be trying to help you earn, hit this threshold and make the earnout. So when it comes to any judgment call, and accounting is full of judgment calls, whenever it comes to anything like that, the buyer's not going to err on the side of helping you to basically earn this earnout. So when you deal with net numbers like net income or profit, right, earnings, that's in the seller's control. And a seller who has a big business will be incentivized to move expenses into your business. However, it's being calculated for your earnout purposes. These are things that you won't be able to control. When our sellers absolutely insist on doing it this way, we have been successful with getting language in purchase agreements that tries to control for this, but there are just limits. You're way better off with a number like revenue, gross funds collected, something that you're going to have easier visibility into and is less manipulable. Very, very important. And frankly, even as a buyer, you might want to avoid this because it's ripe for litigation. There's a lot of earnout litigation, and it tends to focus around net numbers and what the buyer did to reduce that metric so that the earnout wasn't ultimately achieved. Second thing, avoid at all costs, again, unless you do it with your eyes wide open, have to do it to get a deal done, or already got through the guaranteed purchase price all the money you wanted, and this is just gravy. Otherwise, avoid cliff-type earnouts. And this goes whether or not your metric is profit, which again, avoid, or revenue, or it's a number of customers. But when our sellers structure their earnouts as all or nothing, in other words, if the business you sell makes $5 million next year, you will receive another $1 million. That is a problem. If the business blows away the number, doesn't matter. If it falls wildly short, doesn't matter. But most of the time, we're in that murky middle where you have every incentive as a buyer to make that revenue number fall at $4,999,999 rather than $5 million. It's constantly an issue. We're dealing with a dispute right now where the seller negotiated a structure like this. A deal we were involved in, the seller wanted to do it this way, and we talked about it, but ultimately it's one of these, and it's gross funds, it's revenue based, so that's good, but it's, if you hit this number, you get another $750,000. If you don't, you get nothing. big issue. And again, the buyer has every reason to try to avoid that. Now, there might be limits, and an ethical buyer may acknowledge those limits. Others, maybe not. But still, you're giving them incentive. And again, it comes back to there will be inevitably some judgment calls. All right, a lot of businesses don't get paid with checks anymore, but just imagine a world in which the buyer gets a check for the business on the December 31st. Now they have a tax reason they want to probably deposit it on January 1st, at least back in the day used to. But the point being for your earnout, you think the buyer is going to run to the bank, put that money in if it's a cash-based earnout metric and book that into your earnout year versus a day later when it doesn't count? Of course not. And is that unethical? I mean, maybe you could argue it, but it doesn't seem it clearly to me. We've just given the buyer too much control. And again, that is something the buyer may do anyway, but they're particularly inclined to do it where it's this all or nothing cliff-based style earnout. You're much better off with something that looks staggered. In other words, if the business hits $4 million next year, you get $100,000. If it hits $4.25 million, you get $200,000. If it hits 4.5, you get $500,000. If it hits 4.75, you get $750,000. I mean, something like that, or you can convert into percentages. Much, much better off. If you have some war stories and experience with any of this, would love your comments down below. I appreciate you watching today.